Hi there, Tom Jeffries at HowStreet.com's YouTube video channel. Usually on our audio channel at HowStreet.com, we have This Week with Dave Skarica. This time a special edition because Dave's in town for the Cambridge Investment Show. We're right in front of the Trade and Convention Center. Dave, good to have you back in the West.
So it's very nice to be here.
Good to have you. David, on a weekly basis, we have the charts. This week we don't, so just some general questions. First of all, chart action. Are we in a bear market still, or are we starting to head into a bull?
It's really difficult because I think there's different markets which are in different stages of these things. And we've talked about this in our audio reports. If you look at the Asian markets, a lot of them are 50, 60, in case of India, 100% from their lows. And just from a basic charting standpoint, I can't see them trading to new lows. So I think Asia might have ended their bear market last in the November to March timeframe. But on the other hand, the United States and the S&P 500, I wouldn't be surprised if, even though I'm not really bearish, if we did see another leg lower. But again, I think one thing you have to look at this, and you had Mark Faber on talking to actually this exact same spot, right. And I think where he's right is we may have hit the nominal low for this, at 666 on the S&P 500, right. But inflation adjusted, I still think we're going to ultimately go lower. Now, if I can compare it to anything, if you look at the low of the Dow in 1974, it was 550. Now, wow. The print low was the low for that bear market. But see, the Dow again hit about 800 in 1982, and inflation adjusted, that low was lower than the 74 low. Okay. So that's kind of where I think we're going. So I think that this rally, if I'm correct, will still continue a little higher, maybe to 11 or 1200 in the S&P, and then you'll be going up and down, but we're really going to see in the second phase of this secular bear market, which should be in the 2010 to 2020 period, will be met with higher inflation rates because of all the money printing, all the issuance of debt, the probably death of the dollar to lead into that, right. And that will lead to a lower secular low. And then if you look at the S&P in terms of the price of gold and the price of euros and the price of Canadian dollars, it will probably go to lows in price of those currencies or assets, lower lows within the next 10 years. So it's funny because people just like to say, oh, bear market rally, the market's going to new lows, but sometimes it's not quite as easy or simple as that. Like, for example, the S&P hit a new high in 2007, broke the 2000 high, but it was only a couple percent higher. And again, if you adjusted the S&P in terms of gold, in terms of Canadian dollars, in terms of inflation, the 2007 high was much lower than the 2000 high.
Is there a real correlation with the movement of the price of oil and the price of gold, David?
Yes, usually they move together. Because all commodities usually kind of, I guess the rising water raises all ships or whatever. Right. Yeah, sorry, bad analogy. But anyhow, they usually commodities move together. But I actually look at ratios, which basically, and I actually talked about this when I was on BNN in January, that you compare gold to the price of oil, and there's actually certain issues. Like, for example, let me give you a perfect example. In the mid-2000s, when oil was, say, $70, $80 and gold was only $600, $700, the ratio is about 10 to 1. When the ratio of gold to oil is only 10 to 1, gold is cheap. You want to buy gold. Oil is expensive to gold. But then back in the fourth quarter of last year, early this year, the ratio got up to about 20 to 25 to 1. Gold was almost 1,000 and oil got down to 35. Right, so that's about 27, 26 to 1. Right. When that ratio comes in, you actually want to be long oil more than gold. So they kind of move together, but on the other hand, there are times when gold gets expensive and oil gets expensive, and it's worth. Like if you would have sold your gold at 900, gold's basically there now, and you could have bought oil at 40, and now oil's almost 70. Or in the mid 2000s, if you had sold your oil at say 80 or 90 and bought your gold at 500 or 600, gold almost doubled to 1,000, and oil, even though it went to as high as 140, crashed right back down to 40. So you can play these ratios. See, right now, the ratio with oil at 70 and gold at, say, 950 is about 13 to 1, and that's about the historical average. So right now, neither or is cheap against each other.
One of your first one of your first books was about the crash and about the leading up to the crash in the 1920s. Do you think we're facing an 1873 situation in our markets where we have a banking crisis, we have a currency crisis, et cetera, et cetera, et cetera? What's going on?
Yeah, I think that one of the leading factors in, say, the next wave down in the market or hitting this inflation adjusted low will be a currency crisis. I think that, I know a lot of the deflation, as you mentioned, 1873 or 2029, they talk that the US dollar actually gets stronger because of the destruction of credit, destruction of dollars. But see, I think the difference between now and then is that if you actually looked at the early 30s, they barely ran deficits. Even Roosevelt's biggest deficit, I think, was 37 or 38 after the economy fell back into recession, was only 5 or 6% of GDP. Now they have a deficit 13% of GDP. They have to issue all these bonds. And my presentation here at the show today is about the super bubble. What the super bubble, we've talked about this, is all the funds flowing into the U.S. from all around the world, then Americans buying other people's goods. Well, now that's going to stop. So I think that leads to what? More supply of U.S. currency come on the market, not enough demand, and a lower dollar. And actually, I think the best, you're talking about these crises, the best way to structure is the way Bill Fleckenstein has structured it.
Right.
We first had the financial crisis last year. And if you look at things like the TED spread and that sort of thing, it doesn't really look like we're entering another financial crisis right now. Credit is flowing maybe at a slower rate, maybe people don't want to borrow as much, but banks aren't on the verge of imploding right now, right? Then the next crisis is the economic crisis, which we're seeing right now, big unemployment, layoffs, etc. And then the third crisis, and this is kind of like the next thing, the shoe to drop, is the funding crisis, where they want to do all these things in the States and issue these big deficits, but who's going to buy that? And I think that funding crisis leads to a currency crisis, and basically that leads to a leg lower in the stock market, but you might not see that in nominal terms because there's being higher inflation and that sort of thing. And again, the last difference between now and the 20s or the 30s is that then the U.S. government was a net creditor, and debt back then was probably at the beginning of the crisis, 1929, 13% or 15% of GDP. Now the U.S. Government deficit's already 50 to 60% of GDP. It's going to 100, and that doesn't include all the state deficits. So the U.S. government deficits are probably well north of 100%, and the difference between those deficits and say credit debt can be destroyed because we see like the leverage and housing prices going down. But governments can pay off their own debts, especially when they're priced in their own currencies, print money. So I think that leads to inflation down the line too.
Well, look at Japan, 200% get.
But see, Japan doesn't have consumer debt. Japan has a big savings rate. So the Japanese central bank would think to themselves, you know what? We don't want to inflate away our currency because we're going to inflate our own savings. So they can take on more debt, and the Japanese states and cities are in better financial conditions in the U.S. Just think of the states and cities and municipalities in the U.S. You're probably talking closer to 150% of GDP when that's all said and done. And you look at Canada, you're at 30% on the national level, and probably including, again, the municipalities and the provinces, you're probably at 50%. So it's we are in a much better financial condition. And if I'm right, and you get an inflationary bust in the U.S., but the rest of the globe does okay, well, that's actually good for not that bad for Canada because we'll be a big exporter of commodities. And not only that, we've already seen kind of our manufacturing base get hammered. So that part of the down cycle is probably over in Canada. Now, we're going to still have some asset-based problems. Real estate, especially in the city we're in right now, is probably going to fall a little further and that sort of thing. But I just don't see Canada being as hit as hard in this.
Well, one question people are asking about in Canada, since we're a small population, the old aphorism is, if the United States get the flu, we get pneumonia or go intensive care. Do you think that is still the case? People also on the other side say Canada's strong.
I think there's somewhat of a truth to that. Like, for example, I really saw it on this trip. My flights from Nassau to Toronto, Vancouver are half empty.
Oh, really?
Now, granted, I was flying Air Canada, which is kind of always in bankruptcy and doesn't have the best, it's not the best structured company. But I hadn't seen that to date yet. Like even when I was flying in January to the show or to Calgary in April, my flights were all still pretty full. Now, granted, Nassau to Toronto this time of year, this is definitely the down season for tourism, so I'm not going to take that too seriously, but I was really surprised to see the Toronto to Vancouver flight that empty. So I think we are seeing some weakness in the economy here, but again, you don't have the structural problems here. Now, the average person has a debt problem, and we had a real estate, mini real estate bubble. But we don't have the leverage in the system. We don't have the systemic problems that they have in the U.S. Like, remember, when we're spending on stimulus, we're spending it to maybe wasting money. We may be buying
$1 billion.
Monstrosities such as these, right? But at least we don't have to spend a lot of that stimulus and just capital to bail out banks and automobile companies, even though they did take a slight stake in GM. But remember, it's a lot smaller scale here.
Our guest has been David Skarica. Visit David and his team at addictedtoprofits.net and visit us on House Street every Friday audio. This week with Dave Skarica is prominently. David, thanks for taking the time.
Much.
Good to see you again back in Vancouver.
Nice to be here.
David Skarica, Tom Jeffries for House Street. Thanks for tuning in. We'll see you again.
Comments made on House Street Video and HouseStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HouseStreet.com. House Street Video is a production of House Street Media Incorporated.